welcome to today's video. In this episode, we will be talking about financial markets and the United States. There is a lot of news circulating around bonds, stocks, property, and other investments, along with concerns about rising inflation. It seems like everything is going down, except for inflation, which is on the rise. The chairman of the Federal Reserve Board of the United States, Jerome Powell, and his colleagues are prioritizing fighting inflation by raising interest rates, which is causing economic activity to slow down. However, the decline in stocks is mainly concentrated in volatile technology sectors. Higher interest rates favor savers and long-term investors, and the crash of cryptocurrencies, which is essentially gambling, is stabilizing. Although labor markets remain tight, we are not yet in a traditional recession. This means that working people may now be reversing their long-term decline in relative real income. It's important to take a longer-term perspective to gain valuable context. The Great Depression remains distinctively destructive, and the 1929 stock market collapse proved to be the spark for a decade of extraordinary economic crises and human misery. The crash was sudden and steep, with U.S. stocks losing 25% of their value over 2 days from the 381.17 peak on September 3. November brought recovery, but that proved fleeting. Stocks drifted to the historic low of 41.22 in July 1932. During the height of the selling frenzy, they traded in volumes not reached again until the late 1960s. Stocks did not return to the 1929 peak until the 1950s, in great contrast to more recent experiences. However, after the 2007 financial crash, banks failed and others remained solvent only through emergency government support. The Federal Deposit Insurance Corporation, established during the Great Depression, proved up to the task of protecting individual depositors. The 2008 bankruptcy of investment bank Lehman Brothers underscored the scale of the crisis. Nonetheless, sustained government intervention re-established financial stability and supported the recovery. Chairman Paul Volcker of the Federal Reserve defeated inflation in the early 1980s, and that example informs current efforts. Traditionally, the money supply and interest rates have been principal tools. The Fed today controls a relatively small share of total dollars, and the global reserve role of the dollar facilitates ongoing private investment worldwide. Most importantly, markets today are generally more fluid and robust. Money is a universally accepted means of exchange, but tangible value results from the work of enormous, diverse arrays of people. The U.S. has the most productive economy in the world, and our gross domestic product has doubled about every 2 decades since 1940. As a citizen, it's important to be active and exercise serious, sustained public oversight of financial activities. As an investor, it's crucial to do your homework. One resource is the classic book by Dodd and Graham, respectively a professor and a Wall Street genius, first published in 1934 and regularly revised. The basic truths of investing remain unchanged. Lastly, the core importance of committed, dedicated workers remains unchanged. The current high demand for employees underscores the truth of this observation. That's it for today's video. Thanks for watching. And don't forget to hit the like button and subscribe for more insightful content like this.